Welcome back to Cheddar's opening bell, everyone. Futures surging this morning with the Dow set to rally more than 700 points at the open. This after a shocking May jobs report showing 2.5 million jobs were added in the month of May, with the unemployment rate dropping to 13.3%. Economists were anticipating 8 million jobs lost at an unemployment rate of nearly 20%. For more on this, we're joined by Kathryn Rooney Vera, head of research and strategy at Baltic. Kathryn, it's good to have you with us this morning. No one was expecting this, that we would actually add 2.5 million jobs. What's your reaction?
No one was expecting this, you're right, and I think it has a lot to do with the government programs. So you had the PPP program, which of course took some time to get enrolled in. So my suspicion, and we're still digging through these numbers, it's very shocking data, employment report, as you mentioned. Our suspicion, however, is that a lot of employers maybe furloughed people and then brought them on as soon as they received the PPP program from the federal government. So there is that component of it. And I think you have a lot of furloughed workers that were subsequently brought back to certain sectors. So I think there are also some technical issues with the data. Remember that BLS and non-farm payrolls report specifically looks at nationwide data. And as we well know, you have this, it's become this political divide between the blue states and the red states. But the point is that each state is different. Some states are opening faster than others. Some are completely still, shuttered and shut down. But one thing I'll add in addition is that this is a consumption-based economy. Our economy is 3/4 consumption-based, and consumption is still pretty shut off. So I am very suspicious and cautious with regard to the equity market surge.
Okay, so I'm really glad that you're adding a note of caution here, Kathryn, because I think for some people, when they first saw this, they might have actually even thought it was an error, considering how good it was versus how bad it was expected to be. Let's break this down sector by sector. Leisure and hospitality adding 1.2 million jobs thanks to restaurants. There were losses in the hotel sector, though. Construction adding 464,000 jobs. Education and healthcare services adding 424,000, retail up 368,000, and other personal services like laundry actually adding 272,000 jobs, with manufacturing putting 225,000 Americans back to work. Now, which sectors, when you look at this, Kathryn, are the most important to a continued economic recovery?
That's a fantastic question. And leisure and hospitality, for example, is about, I would say, 15% of the labor force. But I'm specifically looking at retail. I'm looking at the consumption-driven sectors, or those sectors that are most attached to consumer behavior. If you do get a tendency, which has been up to this point very positive, it would be confirmed by a surge in consumer confidence. If we get the next data point being that consumer confidence jumps and really makes a trend, because we did see a slight increase in the last consumer confidence number, then I would expect retail to pick up. I would expect tourism to pick up. I would expect travel to pick up. So these are the sectors that we're most looking at Baltic.
So we've been talking about this divide between Wall Street and Main Street hitting a fever pitch this week between the civil unrest, the pandemic, the unemployment picture, which is still elevated, 13.3% unemployment rate, still extremely high compared to where we even were during the financial crisis. And I know that you mentioned that you think you're a little bit suspicious of the gains that we see in the market this morning. I mean, today, a big picture, the rally that we've seen since Memorial Day weekend, do you think that the market has gotten ahead of itself?
Well, the optimism is at euphoric levels at this point. And if you look at CNN has a greed index, I like to look at it. The greed index is rising on the daily. So yes, I do think the market has gotten ahead of itself. And I think it comes down to one thing, and one thing alone. The economy has to recover at unprecedented rates to corroborate the market surge. So from bottom to current, we're up 36%. We're only about 7% from all-time record highs. And that's in the throes of a recession. So the market is absolutely banking on a ferocious V-shaped recovery with the consumer coming back in full force. If that doesn't happen, then I do expect the market to take a leg down, because at the end of the day, you have multiples at 24 times. That's banking on earnings keeping pace with the increase in prices. So if earnings don't, make up for the surge in prices, then the numerator more likely than not has to come down.
So explain to you what's going on behind the scenes. I mean, some economists have said that obviously companies needed to scale back. They needed to focus on essential workers. Companies perhaps taking time during this period to reassess and deem who is essential and how it can potentially cut costs. But in this current environment, if you're going to get earnings growth, I would assume it is mostly coming from cutting costs, no?
No, I agree with that. So costs have certainly been cut, especially from the labor force. What we need to get is that demand component. So if you do get a surge in demand, then you will get earnings growth that are coming off of a very low expectations base. My concern, however, is, as I mentioned, the economic rebound is not as quick as the market is currently anticipating. And in addition to that, really, if you look at the past 2 months, we've had the Fed almost double its balance sheet. We've had the federal government commit to quadrupling the fiscal deficit. So if the market is banking on unlimited fiscal stimuli, both from the federal government and from the Federal Reserve, I think it's going to be disappointed.
Okay, quickly, President Trump set to speak about the jobs report at 10 a.m. Eastern time. Again, a much better report than was actually expected. What does this mean for Trump's potential re-election? Earlier, before these numbers hit, Goldman Sachs saying that a blue wave is getting more likely, and then this surprise report hits. What does that mean for the president?
It's unequivocally positive. If the economy continues in this trend, which is very robust with employment generation, if the economy is strong by November 3rd, it drastically improves President Trump's chances. That's still a ways away. So you have the virus dissipating in its concerns. And if you have a combination of a virus dissipating and you have a strong economy, then I think it bodes very, very well for President Trump.
All right, Kathryn Rooney Vera, she's the head of research and